to Esquire Group's webinar on expatriation planning, getting out without getting killed with taxes. My name is Jimmy Sexton. I am the president and founder of Esquire Group. This presentation was prepared for educational purposes only. This presentation is not legal or tax advice, nor is it to be construed as such. Each individual circumstances are different. You should seek legal and/or tax advice to address any specific questions you may have. Again, my name is Jimmy Sexton. I'm the founder and CEO of Esquire Group. Esquire Group is an international tax advisory firm specializing in strategic consulting and international taxation, including U.S. citizens with foreign income or assets, expatriation, family offices, succession planning, structures for ultra-high net worth individuals, and corporate structures for small and mid-sized enterprises. A bachelor's in business administration with an emphasis in finance at JD and LL.M. So to start off, I'm assuming most of you know, but for those who don't, what is expatriation? So for U.S. citizens, it's relinquishing your U.S. citizenship. So basically becoming not an American citizen anymore. For long-term residents, and long-term residents are green card holders or permanent residents, as they're officially called, who are classified as long-term residents or LTRs. And LTRs are a lawful permanent resident who's been in the U.S., who's been a lawful permanent resident of the U.S. in 8 of the last 15 years, ending on the year of termination. So if you've had a green card for too long, you can be subject to pretty much the same expatriation rules that U.S. citizens are subject to. So the next question that most people have is, okay, now that I know that expatriation is, how do I do it? For U.S. citizens, it's by performing an expatriating act voluntarily with the intent of relinquishing U.S. nationality. Now, there's a long list of what constitutes expatriating acts. It can be working for foreign governments in certain circumstances, or joining the military of a foreign country in some instances. But the most common expatriating acts that we see are renouncing your citizenship or obtaining another citizenship and affirming in writing to a U.S. consular officer that the act was performed voluntarily with the intent to relinquish U.S. nationality. In practical terms, what this means is you make an appointment with the U.S. Embassy, you tell them you want to expatriate. Normally, there's an interview process. You have to go in, fill out some forms, and sign them under oath. You got to pay a fee. I think it's $2,350 these days. And then, usually within a few months, they send you what's known as a CLN, or Certificate of Loss of Nationality, and you're expatriating. Now, what does it mean to expatriate? What are the consequences? So here are just a few facts that I think are worth noting. So you lose all rights and privileges associated with U.S. nationality. It's irrevocable, so once you've done it, you can't change your mind about it. Parent or guardian cannot relinquish for a child or incompetent. So that means if you have young children and you want to expatriate for them, you can't do it. They have to wait until they're of age. Generally, the embassies set ages of between 14 or 16. The embassies generally get to choose themselves when somebody is competent to expatriate. You become stateless if you don't have another nationality. So if you don't have like a second passport and you expatriate, then you have no citizenship. It has no effect on tax or military obligations prior to expatriation, no protection from prosecution for crimes committed in the U.S., and it also does not alleviate your financial obligations incurred in the U.S. or as a U.S. citizen abroad. So if you have IRS problems or you were non-compliant prior to expatriation, expatriating doesn't solve that. You still have tax issues. So how do long-term residents expatriate? Well, the process is a little bit different, but it's normally the most common way it's done is by abandoning their green card or permanent resident status by filing Form I-407. Another way is to be treated as electing to be treated as a foreign resident pursuant to a tax treaty with the U.S. And you don't waive treaty benefits, and you inform the IRS by filing Form 8833 and 8854 that you're planning on being treated as a foreign resident under tax treaty, and that can be treated as expatriation. Permanent resident status can also be revoked for various reasons, like committing crime in the U.S. or something like that. The main consequence for long-term residents is that they lose the right to permanently reside in the U.S. Now, these items were a little bit off topic for the title of this webinar, which is how to get out without getting killed on taxes. But I thought it would be a good primer to go over a few things just in case anybody was wondering or needed a little bit more information. What are the tax consequences of expatriation? Like with all things tax, the answer is it depends. And what it depends on is whether you are what's known as a covered expatriate or a non-covered expatriate. The major difference between covered expatriates and non-covered expatriates is covered expatriates have to are subject to an exit tax regime. So obviously, from a tax standpoint, it's much better to be a non-covered expatriate than a covered expatriate. So, the next question is inevitably, who is a covered expatriate? And an expatriate is somebody that meets one of these following three criteria. One has a net worth $2 million or more. If your net worth is $2 million or more and you're going to expatriate, you're an expatriate. You have an average annual U.S. income tax liability of $165,000 or more for the 5-year period prior to expatriation. Now, it's not $165,000 in income. That's a common mistake. It's $165,000 in tax. So the way you figure this out is you add up all the income tax for the 5 years prior to the year you expatriated that you paid, and then you divide it by 5. And if that number is 165 or more, you're a covered expatriate. If it's not, and you don't meet any of the other criteria, then you'd be an uncovered expatriate. And the final criteria is if you fail to certify that you've been tax compliant for the 5 years prior to expatriation. So the three criteria for being a covered expatriate is if you have a net worth of $2 million or more, you're a covered expatriate. If you have an average annual income tax liability of $165,000 or more for the 5-year period prior to expatriation, you're a covered expatriate. And if you're not tax compliant for the 5 years prior to expatriation, regardless of your net worth or income tax liability, you're a covered expatriate. There are some exceptions to the covered expatriate status, although limited. One is if you're a dual citizen at birth and you continue to be a citizen and taxed as a resident of the other country, and you haven't been present in the U.S. for more than 10 of the last 15 years, then you can be exempted from the net worth test and the average annual income tax test, but not the tax compliance test. So an example of how this exception works is, let's say you have somebody who's born a dual national, let's say U.S. and Austrian. And at the time the person goes to expatriate, they're still an Austrian citizen. They live in Austria, they pay taxes in Austria, and they've lived in the U.S. only 2 years in their whole life. That person, even if they were worth $10 million and was paying $300,000 a year in taxes, as long as they were tax compliant, could still expatriate as an uncovered expatriate under this exception. If, however, they were not tax compliant, then they would be considered a covered expatriate. The other exception is relinquishing U.S. citizenship before reaching the age of 18 and a half and has not been a U.S. resident for more than 10 years prior to relinquishment. So those are the criteria and the exceptions to being a covered expatriate. So who's a non-covered expatriate? Everybody else. Anybody who's not a covered expatriate is a non-covered expatriate. And like I said, from a tax standpoint, that's really who you want to be. Non-covered expatriates, the reason why you want to be a non-covered expatriate from a tax standpoint is because you can basically expatriate without any tax consequences. And you become a foreigner pretty much just like anybody else. Covered expatriates, unfortunately, don't have it so nice. So covered expatriates, first off, they're subject to a mark-to-market tax on unrealized gains. So basically what your unrealized gains are is you add up all of your assets and you figured out what you paid for them and you figured out what they're worth today. And then you pretend you sold them on the day before expatriation, and you figure out if there's a gain. If there is a gain, that gain is subject to tax. If, however, the gain is less than $713,000, you wouldn't actually pay any tax on that because of the $713,000 gain exclusion. So covered expatriates are subject to this mark-to-market tax and would normally have to pay tax on any gains, but only if it's over the $713,000 gain exclusion amount. Also, deferred compensation items like IRAs, 401ks, annuities, pensions, stuff like that, are generally treated as distributed and taxed in the year of expatriation, normally as ordinary income. So that those could boost the tax bill for a covered expatriate during an expatriation year quite a bit. Another thing that a lot of people don't count on is the impact on gift and estate taxes. And then the impact from gift and estate taxes is normally if you're a U.S. person, you can inherit an unlimited amount of money from foreigners or receive an unlimited amount of gifts from foreigners without having to pay any tax on those gifts or inheritances. If, however, you're a U.S. person and you inherit from a covered expatriate, you as the recipient of that gift are required to pay the gift or estate tax on that gift up to 40%. That's the opposite of how U.S. state and gift tax normally works. Normally, it's the person giving the gift or the person's estate who's deceased that pays the tax, not the recipient. So that is a downside for, if you have parents that are covered expatriates and their kids are still U.S. citizens, it gets really tricky with estate planning because those kids, if they're still U.S. citizens at the time that they inherit from their parents or receive gifts from their parents, they're going to have to pay the tax on at the highest gift tax rate then in effect. Some tax consequences that apply to all expatriates is the loss of the lifetime gift tax exclusion. So everybody knows you have this lifetime gift and estate tax exclusion, 5.6 million currently, and everybody has the lifetime gift tax exclusion. I believe it's up over 10 million now. With the state and the gift tax exclusion, you can give up to the gift or estate tax exclusion amount tax-free. And so once you expatriate, you lose that ability. So a lot of times, especially if you're a covered expatriate where the U.S. recipients of gifts would have to pay tax, a lot of times you want to try to take care of those gifts or do some estate planning prior to expatriation. The other thing is as an expatriate, if you continue to have U.S. source income after expatriation, like interest, dividends, pensions, Social Security, things like that, it could be subject to a flat withholding tax in the U.S. on the outbound payment. Here's the tax compliance obligations for expatriates. So in the year of expatriation, you have to file what's known as a dual status tax return. It's a partially non-resident and partially resident tax return, resident for the part of the year you were a citizen, non-resident for the part of the year you were not a citizen or a long-term resident. You also have to file Form 8854. There's a $10,000 penalty for failure to file Form 8854, and you must continue to file U.S. tax return report U.S. source income. One mistake I'd like to point out on this slide is that failure to file Form 8854 results in continued taxation as a U.S. citizen resident. There is some dispute on whether or not that is in fact accurate, and I think the majority of people lean towards it is not. I actually intended to take this out of the presentation, but I forgot, so I thought it was worth mentioning. So here's some tax tips for saving on taxes prior to expatriation or while planning your expatriation. So be tax compliant, right? If you're a non-covered expatriate, if you would otherwise be a non-covered expatriate, being non-tax compliant can blow it for you, and you could become a covered expatriate. Take advantage, I said tax advantage, take advantage of any exemptions from being a covered expatriate. So for example, if you qualify for that dual citizen at birth exclusion or expatriating prior to being 18 and a half, if you qualify for those, take advantage. Take advantage of any exclusions you're entitled to. So like the gain exclusion, for example, on the mark-to-market tax. As I said, utilize your lifetime gift tax exclusion if it's appropriate. If you're going to be a covered expatriate and there's going to be the recipients of future gifts after you've expatriated are going to be subject to U.S. gift tax. You might as well use up your gift exclusion amount before you expatriate and do it all tax-free. And especially if you're going to be a covered expatriate, do some tax planning. There's a lot of times where with proper tax planning, you can help somebody who would otherwise be a covered expatriate become an uncovered expatriate. Here's our contact details if anybody has needs any assistance with expatriation. We can help with pre-expatriation planning, help you through the expatriation process and all your post-expatriation compliance. So I will thank everybody for attending tonight. I hope that you've enjoyed the webinar and that you've gotten some useful information, and look forward to seeing you in a future Esquire Group webinar. Everybody have a good day or night, depending on where you're at. Bye-bye.